What does profit have to do with interest? And what does the rate of profit have to do with the interest rate? Here's a business and here's a bank. The business wants to make an investment which will increase its output by 2%. It wants to expand its production, and assuming its productivity stays the same, its outputs also need to expand by 2%, whether that's the workforce, material, whatever. And the business, when it sells this extra 2%, part of the price of that's going to be its profit margin, just like the existing sales. So it's going to make a profit. It's going to increase its overall profits. But it doesn't have those profits yet. It needs to pay for the inputs to create that expansion in the first place. So it has to borrow money from the bank. The business doesn't have any of its own funds to invest. So the whole initial costs, it's borrowing from the bank to pay for the additional wages for workers, more workers, additional inputs, and so on. Let's say the costs for this extra 2% of inputs is $100. Then the increased output has to sell for 100 plus an amount that will repay the principal and the interest charged on that principal and profits for the business. Whether this investment is feasible, if it's going to be profitable for the business and they're going to borrow the money, depends on what the interest rate is offered by the bank and what the profit rate is of the business. If the costs are 100 euros and the sales price is $102, sorry, not euros, the rate of profit is 2%. If the interest rate is also 2%, then the business isn't going to take this loan because it can use its profits to continue paying back, covering the interest costs, but it can never pay down the principal or never build up the money necessary to pay the principal when it's due. So say if this loan was for 10 years, it only had to pay that back in 10 years. If this situation didn't change and stayed the same, the business could spend all that time using its profits to pay off the interest costs. So the sum it had to pay didn't increase. It kept on top of the interest costs. But at the end of the 10 years, when the loan matures, it can't pay back the principal. So that means for the business to take this loan, the interest rate has to be less than the rate of profit, so that over time, part of the profits can go to paying off the interest and part to paying off the principal that was borrowed. The business isn't going to make the investment anyway if there isn't demand for this extra 2% of production. So first of all, the business considers that this is something in of itself profitable, forgetting about the financing for a second. It's going to do something which there's demand for, something which in the real economy there's demand for, which means that the interest rate, how it relates to the rate of profit of this particular investment possibility, determines whether this production is going to be increased and the demand met, whether there's something real that's going to change in the economy. If we consider that the main interest rate, the policy rate, is set by the central bank, it's not the result of any market, it's its policy of the central bank to set its interest rate around which all other interest rates orient themselves. Maybe it's a bit more for something a bit riskier, or longer term, there's a premium for that, a higher interest rate. But even then, if the central bank lowers its policy short-term rate, the longer term riskier is going to come down as well. There'll still be a difference, but all other interest rates anchor themselves on the policy rate of the central bank, which means the central bank has a choice as to how much real economic activity is happening, how many resources are being used, how much investment's being made. To understand that, we can ask what the relation is between profits, interest, and growth, and the rate of growth. This is, for example, the growth in GDP of a country. Now we have many businesses. Here's business 1, business 2, business 3. If we imagine that these 3 businesses are the whole economy and they continue producing the same amount year after year, then there's no growth, no change in the GDP. To make it simple, let's say there's 4 businesses and each business produces the same amount in terms of value. So each of them produce a quarter or 25% of the GDP. The GDP divided by these 4 equally productive businesses. Growth is going to be the weighted average of the profits of these 4 businesses. So business 1 and 2 make up half of GDP, and let's imagine they each increase their output by 5%. So 50% of GDP has increased its output by 5%, which is a 2.5% increase in GDP. Let's say business 3 and 4, which together are also responsible for 50% of the output, increase their output by 10% each. Then 50% of GDP of output by 10% is 5%, which means together there's been a 7.5% rate of growth, or growth. The economy has grown 7.5% in the period of time in which this happened, let's say a year. Each of these 2 businesses increased their yearly output by 5%, these 2 by 10%. Let's imagine that the interest rate in this economy is 3%. Let's say this is the interest rate often used as a indicator for business borrowing, 10-year bonds, 10-year government bonds, because a 10-year loan is often the sort of long-term borrowing that a business would need to make in order to fund fixed capital costs, so long-term investments like new factories or whatever else it might be. So imagine they have to pay 3% interest on long-term borrowing. From the perspective of each business alone, it's the same thing as before. What's their profit in comparison to the interest they have to pay? For example, if in business 1 the rate of profit is 4%, maybe that extra percent isn't enough. They can cover the interest payments, but maybe that extra percent isn't enough to pay off the principal in time. Whatever the profit rates for these 4 businesses are, we're assuming, like I said before, that there's been no increase in productivity. They're just expanding their production. So the rates of profit being constant, but just now being made on a larger output, then if all 4 of these investments were made, the profits being made in a year in the entire economy would also increase by 7.5%. So even though we haven't established any direct connection between interest and growth, it seems that maybe growth has some sort of correlation with, or can act as a proxy for, the growth of profits. And the interest rate here is less than 7.5%. And so this is a good indicator, this extra margin, that all these investments are going to be made. But it's per definition, because if for this individual business the interest rate was too high for its profit rate, then it's not going to make that investment. And that investment's contribution to the GDP growth, as well as growth in profits, isn't going to occur. So if we correct these down, the growth and profits, aggregate profits being smaller, so the margin, the gap between them and interest rate being smaller, we can see how this is sort of a proxy macroeconomic indicator for how much investment is going to be made in the real economy. The bigger this margin is, the higher growth is compared to the interest rate, the more potential investment is going to be profitable versus not profitable. But I said this is per definition. This has gone down because this investment wasn't made. So how can we use these two indicators? For example, how can the interest rate be used as a policy rate to increase or decrease the amount of investment? Well, it's because, as I said earlier, the financing is one thing, but whether these businesses are going to make this investment in the first place, whether it's even possible, depends on real economic circumstances. For example, the demand for that production. So that's something that exists potentially independently of financing. So if you knew in the previous year the growth was, let's say, 6.25% and the interest rate was 3%, if you then, for the next year, put the interest rate up to 7%, you know the growth you're going to get is going to be much less, because fewer investment plans are going to be profitable in the light of such a big interest rate. And so what's the consequence of this, the lesson to be drawn? Well, let's make a graph. Here on the y-axis is growth, let's say the rate of growth, and here are years, so time. And we have green for the interest rate, let's say that again as an indicator, the 10-year bonds, government bonds interest rate, which is a good indicator for the cost of financing for business investment, and red is growth. You'll see, historically, when growth is low, it's because the interest rate is too high. It's very close or even above it. And when growth starts to pick up, because maybe, again, in the real economy, there's certain circumstances that are conducive to a lot of growth, then if interest rates are kept decently below that, remember the margin is what's between, then the growth will continue. So as long as there's a decent margin, the higher the interest rate is, the more investments aren't feasible, because you're bringing the interest rate above the profit rate. But because in a growing economy, the profit is also dependent on the demand, it means that, let's say, the equivalent project at this time, so it had a profit rate of here, because of this increased demand, which in general, it depends, obviously certain products lose demand or they don't grow, but talking generally, as the income grows, the economy grows, there's more demand for the average product, then an investment in expanding the production of that product may be more profitable. And so even if the interest rate is rising, as long as there's a certain margin between it and the rate of growth, you're allowing a certain amount of the potential investments to be made because they continue to be profitable. But if, because for whatever reason the central bank decides to rapidly increase this rate, maybe that's a bit too sharp, a bit less. You'll see a slowing down of the growth. Maybe in response to that, they choose to moderate the increases again. But now the margin here is less than it was here, for example. So maybe the growth recovers a little bit, but it stays about the same. And let's say in response to that stagnation of growth, slowing down of the rate of increase of growth, the central bank decreases the rate again a bit, the interest rate. Then you'll see growth pick up again. And if they respond to that by increasing it again, because of potential inflationary danger, because there's too much demand on a scarce number of resources, for example, of labor, but also of other materials in the economy, which will drive up prices. So they increase the interest rate specifically to reduce investments, because investments are creating demand for new machines, new workers, etc. Then if this is carried too far and the margin is kept too low, you'll start to see an inversion. Let's just go back to here to have a bit more space. If there's this constant worry about inflation, over worrying about inflation, let's say, and the margin gets smaller and smaller, well then the growth will never have a chance to pick up again. And so even if the interest rate is then kept flat, but the margin isn't allowed to gain again through an absolute reduction in the interest rate, all else being equal, the growth rate isn't going to recover itself. And so what you often see historically is things like this, where maybe the growth starts to pick up again, but because of inflationary fears, this potential is strangled. And then maybe the interest rate is even kept above. And then because of the declining growth, the interest rate is lowered, but it's still kept above. There's an inverted margin, and so it'll just keep declining. When there are actual signs of inflation is starting, then maybe the interest rate can be increased to reduce the pressure on prices. But we've got to remember, in a market, in response to these high prices, if there's competitiveness, there's going to be businesses competing to increase the supply as well. So that temporary inflationary danger will then give way. And so it's very important that then the interest rate be again decreased to allow a healthy margin, and then the growth rate will take care of itself again. And the interest rate can be tracked to it, maybe occasionally in response to real actual inflation, not just the potential, increased again, but then moderated again. Maybe look something like this.